Welcome to Decode Station, where we uncover the hidden psychology, business, and systems behind the world's biggest companies. In today's video, we decode the rise and fall of WeWork. Let's begin. So, to really get to the heart of this incredible story, we're going to break it down into 5 parts. We'll start with the vision, then look at the unbelievable hype it created. After that, we'll expose the fatal flaw in the business, watch the dramatic collapse, and finally unpack the lesson in all of it.
All right, let's start at the beginning. The year is 2010. Our main characters are 2 founders, Adam Neumann and Miguel McKelvey. And they have an idea that honestly seemed pretty straightforward on the surface.
So at its core, WeWork's business model was a classic real estate play. They'd go out and sign these huge long-term leases on entire office buildings. We're talking 10, 15 years. Then they'd come in, give them a facelift with cool furniture and kombucha on tap, and chop up the space to rent out desks in small offices on super flexible month-to-month contracts. But here's where it gets really interesting. WeWork was, for all intents and purposes, a real estate company. But they never talked about themselves that way. No, they sold a much bigger, much sexier story. They were a technology company, a community, even a physical social network. And this narrative was absolutely crucial because investors pay a way higher price for a tech company than they do for a landlord. And that story? It worked like a charm. It acted like pure rocket fuel, launching one of the most aggressive, grow-at-all-costs expansions we've ever seen. People weren't just investing in office space. They truly believed they were buying a piece of the future of work itself. And you can see that belief reflected in the numbers. I mean, look at this. The company's valuation didn't just grow. It went supernova. From $5 billion in 2014 to an absolutely staggering $47 billion just 4 years later. This wasn't normal growth. This was pure venture capital-fueled mania. So where did all that money come from? Well, a huge piece of the pie, over $10 billion, came from a single source, SoftBank's Vision Fund. They weren't just another investor. They were the engine, the primary backers pushing WeWork's relentless global takeover. And with a war chest like that, WeWork went on an absolute tear. By 2018, it felt like they were everywhere. They were a global behemoth with more than 500,000 members in hundreds of locations around the world. The strategy was simple. Get big, get global, and worry about making a profit, well, sometime later. So, a $47 billion valuation, a footprint that spanned the globe. What could possibly go wrong? Well, it turns out that the engine powering all this incredible growth had a fatal flaw, one that was hiding in plain sight the entire time.
And this right here, this is the ticking time bomb. It's a massive mismatch. Think about it. WeWork's bills, their leases, were locked in for decades. Billions of dollars in fixed costs they had to pay. But their income? It came from members on monthly plans who could walk away with just 30 days' notice. Long-term promises funded by short-term cash. That is a recipe for disaster.
That flawed model created a really dangerous and, frankly, kind of absurd financial reality. The more WeWork grew, the more money it lost. I mean, it's all right here. A $430 million loss in 2016 just swelled to nearly $2 billion only 2 years later. They were losing money on almost every new desk they rented. And that's the paradox that lies at the very heart of the WeWork story. You see, unlike a real tech company, where more users often leads to bigger profits, for WeWork, more growth just made the losses bigger. Every new building they opened just dug the financial hole that much deeper. A powerful story can hide some pretty ugly numbers, but it can't hide them forever. And in 2019, that incredible story finally slammed headfirst into reality, and the whole thing started to unravel with breathtaking speed. At the center of this hurricane was the founder, Adam Neumann. He was a truly gifted storyteller, a charismatic visionary who convinced some of the smartest investors in the world that WeWork wasn't just about renting desks. It was about, and I quote, elevating the world's consciousness. That vision was the company's single greatest asset. But along with that vision came some major red flags. There were pretty clear conflicts of interest, like Neumann buying buildings himself and then leasing them back to his own company. And then there was the infamous move where he made WeWork pay him almost $6 million just for the rights to use the word we. For anyone paying attention, these were signs of a serious governance crisis. And then the whole house of cards just collapsed.
It all kicked off when the company filed paperwork to go public. That document, called an S1, basically laid bare all the secrets for the world to see. The insane losses, the weird corporate structure, everything. The reaction from Wall Street was immediate and brutal. Confidence just evaporated. The IPO was pulled, and within weeks, Adam Neumann was out.
And that $47 billion valuation? Poof, gone. It completely vaporized, plummeting to less than $10 billion in a matter of weeks. It was one of the fastest, most shocking destructions of corporate value in modern history. So after all that chaos, what's the lesson here? What can we possibly take away from this incredible story of boom and bust? Well, the WeWork saga is more than just a business school case study. It's a really profound lesson about the difference between a high valuation and actual, tangible value. When you really break it down, the failure rests on four shaky pillars. You had the flawed business model we talked about, an outrageous overvaluation driven by hype, not facts, questionable leadership with way too much control, and a growth strategy that was completely unsustainable. But beyond the balance sheets, there's a fascinating psychological drama at play here. You have highly sophisticated investors falling victim to visionary bias and herd behavior, basically a massive case of FOMO. They got so caught up in the story, so mesmerized by the founder's charisma, that the narrative itself became more real, more powerful than the ugly financial truth. And all this leaves us with a final, critical question. What happens when a captivating story is more powerful than financial reality? WeWork's story is a reminder that perception can be more powerful than reality, but only for a while. Eventually, every system reveals its truth. This is Decode Station. Subscribe to uncover the hidden stories behind the world's most powerful companies.